Okay, hello everyone. So this is where you should be by the end of week 1 and at the start of week 2. So if you can see the screen here, I have a sample balance sheet, which is this, and an income statement. Okay, so these are like the standard format for the firm's financials, and it kind of helps us get a good visual idea as to what is happening within the firm, what is it that we are learning, and how the different aspects of the course kind of build upon each other if we have a good understanding or if you have a good visual representation like this financial statement format. So we're going to be using this quite often throughout the semester. Okay, some format like this. Okay. So what we've done in the first week, so the first thing we had to do is to make sure that we understand how to calculate present values. So we had to calculate the present values for single cash flows, multiple cash flows, annuities, perpetuities, and so on. And then of course, if we know how to calculate the discounted present value, we could also calculate the future value. So basically, making sure that we know how to do the time value of money calculations. So you should be quite familiar with how to use Excel for this. And if you're not clear about how Excel works, I guess the best way to figure that out would be to simply Google for it and say, hey, how do I do something in Excel? And you will get about 500 million hits. That should work. And if for some reason that doesn't work, you can always post your question on Moodle. Now, if you don't want to use Excel, you can always use a financial calculator. And again, all the financial calculators have a pretty extensive user manual which tells you how to do these present value type calculations. Okay. So that was in chapter 4. And then chapter 1 was basically just an overview, so that's fine. And then in chapter 8 and 9, we basically looked at how to value bonds and how to value common stocks using the dividend discount model, which is one way to value stocks. Now, there are multiple ways to value stocks, and if you're taking the equity valuation course 524, you will see some different ways to value stocks. Okay. But the dividend discount model or some discounted cash flow type model is very commonly applied. So the first question that we need to ask ourselves is, why do we need to know how to calculate these present values, future values, and so on? So if you remember the videos, I had basically asked you in the video, hey, why does price equal present value? Okay, how does the value of an asset or the price of an asset equal the present value? Why is that true? So the first thing you should keep in mind is it is not NPV. All right, so the value of an asset is not equal to NPV. The value of the asset is equal to PV, and NPV and PV are different. So the net present value is different from present value. So the value equals present value. So the question that I had asked you was, why is this true? Now, some of you had, emailed me your responses. So let's take a look at some of them. So for example, one response was that, hey, the reason value equals present value is because the present value is the amount of money you could get if you cashed in on your investment. But the question was really asking you as to why this present value is the amount of money that you could get. In other words, why is this present value the price at which the asset will trade in the marketplace? Okay, so this response is not answering that. Okay, so the question is, why is present value the same as the amount of money you could receive? Why? Not whether it is or not, but why? Okay. And why not some other value like, present value plus 10 or present value minus 100 or some other formula? So why should it be equal to exactly present value? Okay, that's a question. Then one of the other responses I received basically said that the value of a firm needs to be relative to the firm's use of the cash flows, which I think is kind of coming closer, so that's good. But then the question is, why is this value equal to present value? Okay, that's the question for which this response does not give an answer. Now there's one other response which I received which was very close, which said that, hey, the value of the price should equal present value because it is dependent upon the systematic risk. Okay, so let's go ahead. So this is a very close argument. Okay, so it's pretty close. So let's see why that will work, and we are going to use an example with a single cash flow. Okay, so we are going to think of a security, like think of it as a bond, which has only one cash flow, which is going to occur at time 1, which is $100. So now the question is, if you were to buy this bond, at what price will it trade in the marketplace at time 0? So you're going to get a cash flow of $100 at time 1, and that's the only cash flow. And what will be the value at time 0? So now let us suppose that the required rate of return is 10% for this investment. So now the question is, this required rate of return R is based on what? Now you've seen in 520 that the required rate of return is based upon risk. Okay, there's a risk return trade-off. Higher the level of risk, higher the level of expected return. So the question then is, okay, it depends on risk, but what type of risk? Well, it depends upon systematic risk. So it does not depend upon unsystematic risk. So then the next question is, why does it not depend upon unsystematic risk? Because unsystematic risk can be diversified away. If you hold a diversified portfolio, you can get rid of it. But you cannot avoid systematic risk. That's also called market risk or covariance risk. So this is something that you cannot avoid. And you've seen in the CAPM that the systematic risk is measured by beta. So this is the risk that cannot be avoided. And the required rate of return R depends upon the level of systematic risk for this investment. Now, how do we say that, hey, there can be an R of 10%? So basically what we are saying is, if you have other assets in the marketplace of similar risk, you are going to be earning 10% of that. Okay. So now I can go ahead and say, let me calculate the discounted present value of this. So the present value will be PV should equal 100 divided by 1 plus R. So that is 1 plus 10%. So that is 1.1 equals 90.91. Okay. So this is my present value. So what I'm saying is, if I have a bond like this, why should the value of the bond here be 90.91? So let us see what will happen if the price is not equal to 90.91. So let us suppose the price equals 95. Then what will happen? An investor, if they invest in this bond at 95, they are going to get $100 at time 1. What is the return on investment? So ROI equals 5 over 95. So that is about 5.3% or thereabouts. Okay, roughly 5.3%. So now you can think about what an investor is going to look at. The investor is going to say, okay, if I were to buy this particular asset at 95, then I'm going to get a return on my investment of 5.3%. But what return will I get in the marketplace for other investments of similar risk? I can go ahead and get 10%. See? That's what I can earn in the marketplace on assets of similar risk. So what will this investor do? This investor is then going to say, okay, I can compare these two alternatives. I'm going to get 5.3% if I go ahead and buy this asset at 95, or I can get a return of 10% in the market. So what will they do? they will all prefer to get 10%, so no one would buy. They would all sell this asset because the return is too low. So what will happen when people sell? The price will decline. So what happens if the price is 85? So it declines all the way down to 85. Then what's my ROI? My return on investment? So that equals, I'm going to get a return of 15 on an investment of 85. So that should equal 17.6%. So now what is an investor going to see? The investor is going to see, hey, if the price is 85, I'm going to earn 17.6% on this bond, but other assets in the marketplace are only going to give me 10%. So this bond is now very attractive. So everyone would buy and price will increase. But if the price increases to more than this 90.91, which is its present value, then what will happen? The ROI will be less than 10%. No one would want to buy. They will all sell and the price will decline. But if the price declines to below this 90.91, then what will happen? You're going to get a return of more than 10%. So this will be a very attractive investment. Everyone will want to buy and the price will increase. So where will there be equilibrium? Only when the price equals present value. So that's the reason why price should equal present value, because that is when there is going to be equilibrium, okay, in the marketplace. Otherwise, there is always going to be an incentive for people to either buy the asset because you're getting a higher return, or to sell the asset because you're getting a lower return. Okay, so there's going to be this constant trading, and this trading by investors is what will make sure that the price equals present value. Okay, so if we back up here now, so I can go ahead and calculate the value of bonds as present value of the future cash flows the investor will get. So you've seen that when you did the bond valuation in chapters 8 and 9. So value of the bond equals present value. When you were looking at stocks, the investors get dividends. So one of the valuation models is the dividend discount model. So you can value the equity as the present value of all future dividends, and that's based on the present value of all future dividends. So that's also based on this time value of money. Okay, so knowing this time value of money calculations is useful for these kinds of valuation decisions. Okay, so that's one. Now second, we need to make sure that we understand this time value of money very well, because it's not only used for valuation, but as you saw in many of the examples in the textbook and even in your homework, it's used in loan payments, it's used in car payments, so it's also very useful in your personal life. Okay, so knowing this, how to do these time value of money calculations is very good. So by the end of week 1, all of you should be comfortable with doing these time value of money calculations and basic bond and stock valuation. Okay, now what is going to be our focus for week 2? Our focus for week 2 is going to be on the asset side of the balance sheet. Okay, and what's happening on the and basically all these things in black and all of these things in the income statement. So what is happening here is basically the firm's operations and marketing, and maybe even strategy, where they're going to be thinking about what kind of products should I make and sell. So the decisions on what kind of products you should make, identifying a gap in the marketplace and so on, the strategy folks may be doing it. Okay, coming up with a good business strategy for the firm. Then once they figure out how to go, whether or not they should make these products, actually making the products, that's a job of operations. Selling it, that's a job of marketing. Okay, so pretty much all the stuff we see on the asset side of the firm deals with the operating aspects of the firm, which is basically operations and marketing. Okay, or everything related to how the firm works.